be taking the long view today. This is going to be my last video for the FT after almost 30 years. And so what I'd like to do is to review world markets since I first joined the FT staff back on New Year's Day 1990. Now if we start on this scale, this is the MSCI All World Stock Index. That includes all both developed and emerging markets. Emerging markets are of course a much bigger proportion of the pie than they used to be. That's the red line. Meanwhile, the blue line here is the 10-year Treasury yield. That's the single most important rate in world finance. It effectively sets the notional risk-free rate for transactions across the globe. And as you can see, if you stand back, it's obviously greatly exciting to see changes and shifts on a weekly or a daily basis, but over the shift of 3 decades, the trends are very clear. In the case of the world stock market, the trend is plainly upwards with the occasional interruption. And that's not surprising because in the very long term, stock markets tend to follow economic growth, and in the long term, economies tend to grow. They don't necessarily do it in conjunction with each other, but in the long term, economic growth drives stock markets. What most motivated me, what I spent most of my time covering during these years, were, however, the times when the stock market stopped going up. 2000 for the dot-com bubble, and perhaps most spectacularly 2007, 2008 with the very severe sell-off that followed the credit crisis, most famously remembered by the Lehman bankruptcy. But again, note both times those who bought at the bottom probably felt very much happier. What was arguably more important and a much clearer trend that we didn't report as much about was the much bigger market for bonds. The trend in bond yields is about as clear as you could possibly ask it to be. It is downwards. One of the most famous and reliable trends in world finance. The reason for that ultimately is that inflation came under control in the 80s, or was perceived to do. And if you're less worried about inflation, then you need less of an interest rate to, for future transactions. As a result, that ever cheapening money helps to support the stock market. And what you do see is that whenever there is an interruption to the trend, or close to an interruption, such as in 1994, when Alan Greenspan surprised people by tightening rates, or when the Fed again raised rates to try to curb the dot-com boom, or most dramatically when you had a spike in yields ahead of the credit crisis, it tends to mean that stocks soon run into trouble. Now that is an issue because, as you can see, in the last few years, it really does look as though that ever-reducing trend for bond yields has finally come to an end. It looks as though it's flatlining and very gently starting to increase. And early this year, we got back through the 3% level. Round numbers do matter to psychology. And what is interesting is that world stocks as a whole, not the US, but the world stocks as a whole, peaked back in January of this year and have not got back to that peak while bonds have been consolidating at a high level. I suspect that over the next few decades, I never got to cover a bond market that was doing anything other than steadily reducing. I suspect my successors are going to have a great deal of excitement trying to work out what is going to happen if bond yields really start doing that again, and what effect that will have on stocks. And with that, it just remains for me to say thank you for the unsung heroes, Greg and Danelle, who film and produce this, and the unsung heroines, Joanna, Brooke, and Fan, who produce the graphics. From me, that's all, folks.